Welcome back to another banger by MIG. What we've got here is the new release of the absorption flow model. Basically, the closest thing that you'll get to a bookmap style absorption model, I suppose. First off, big congratulations to everyone that's passed their evaluation, sent it out, following our live daily streams that are currently free for everyone, as well as our just using liquidity edge periods. I've got some people that are in there for 4 days passing evals and getting payouts. So what we'll do is we'll go straight into a breakdown for this, but before I get into the settings, some context, okay? So on Bookmap, absorption is used to basically spot where passive limit orders are sitting and absorbing aggressive buying or selling at that key area. Okay, so when we're using this, we're not using it as a random buy or sell button. We still use it as a confirmation tool. Simple as that. We already care about a level. We just need to ensure it's the same ones that we use for liquidity edge, our prior highs, prior lows, extreme session areas, our liquidity sweeps, our higher time frame areas, which is why utilizing this alongside liquidity edge is so important, which is why we've just priced it as an add-on, as opposed to a completely new system. My job is to get retail traders at home the closest breakdown and understanding institutionally, whilst keeping it accessible. And I think we're doing a fucking good job of that. Now, what we want to see is if heavy buying, for example, is just hitting into an area and price cannot continue higher, this will suggest to us that sell side absorption is taking place. Okay. Same way on the other side. If heavy sellers keep hitting into a level and the price cannot continue lower, this can suggest that buy side absorption. And that is printed to us in the form of bubbles. Okay. Some people call it temperatures, trading planets, etc. From an order flow perspective, around Bookmap consistently frames this as part of reading the interaction between aggressive orders, passive liquidity, key levels, rather than relying on lagging indicators. Okay, obviously this isn't a replacement for raw order book data, but this gives you a far more accessible way to read that reaction directly into the chart. Okay, so rather than needing a full depth and heat map platform that's like $300, $400, $500 a month sometimes, we've given you the whole tool suite for $50 a month. Location is very, very important. Okay, so what we'll do is we'll jump straight into the chart in 3, 2, code, glaze me. So what we're effectively looking for location-wise first, but we'll give you a breakdown of settings. Settings are really straightforward. Wrong settings. Settings are really straightforward. We have a depth flow dominance the same way we do on liquidity edge. We have two modes. We have a free proxy and we have a premium footprint. Try to keep it accessible to everyone. Free proxy will only allow you to see the data on the chart that you're on. Premium will allow you to see a bit more of a breakdown, a magnified on look, being able to see those true grains of sand within the whole vastness of the desert. So an example being, if we put this on 5 seconds, we're looking at 12 lots of 5 seconds of data in a 1-minute chart. Okay, quite straightforward. Confirmed bars only. Confirmed bars only is basically whether or not you want the candle to close, then print, and use that as a confirmation. I like to keep that off. Reason being is I know that it might flash on and off during that candle, but it still allows me to see when I'm focusing on a key area who is winning that battle. Are those sellers hitting harder and pulling through? Or are the sellers completely smashing down, but they get stuck and then it prints green instead? And that tells me that the buyers came in far heavier. The bigger the bubble, the bigger the impact, the bigger the absorption, okay? The same way we have a breakdown on the liquidity edge with dominance of that area, 93% buyers to 7% sellers, 87 to 13, and then a breakdown of that specific volume. The difference is now that is of an area, that is our location. So the first thing we do is we look for where to trade from a heat map side, and then we look at when to trade. And now this is that when, okay? So yes, trading the model independently has printed us 6.5 weeks of 100%, both in the private chat. All of my personal trades get sent there, as well as the daily live stream. But if you want that added confluence, that further step, because by the end of this, you guys will be 85% of your way of trading, the closest thing to institutional order flow. Now, this is why location is important first. Okay, the rest of the settings are pretty straightforward. Show upper dots, lower dots, mid dots, where they actually take place in the candle, where those buyers and sellers are being absorbed, and then show large bubble on strong signals. I keep that on a 72. What we'd call it on Bookmap is iceberg style, so we can change that based off of how strong we want it. The higher the number, the bigger the bubble, and also the fewer the actual signals. So if you truly just want a print, and obviously even on 72 we don't see those bubbles too often, but in key areas we should be able to, if we can find one really quickly. See, here we go. Certain key areas we can see where that huge momentum is coming in. And when we've got a candle like this that just printed a massive red sell that pushed that down, imagine how many buyers there had to be in order for that amount of sellers to still try to drive the candle down. Then on top of that, for it to print bullish afterwards. Okay, clear example. And in fact, I'll continue using this example. First things first, we're in a liquidity edge, 15-minute, higher time frame, A plus C. That is enough to take any rejection, period. Okay, we're also covered by this huge 1 minute block down here. So we've got a dual layer of buyers that shows us that we're going most probably into a bullish trend. Now, there's two positions you could have taken a trade. Okay, so we already know that we're in bullish territory. Two places to take a trade. Number one, clear bullish candle with huge amount of selling momentum. Okay, next candle printed the exact same. Then we see a bullish push. That tells me the buyers are absolutely clapping cheeks. That's the first place. The second place is maybe waiting for this area to break slightly. Okay, seeing that break, that slight push, and seeing this here. Okay, we're about to break through this. We now know the buyers have truly stepped in. We've broken out of this range. If we're looking at it purely out of a candlestick basis as opposed to a wick basis, we've broken out of this range. This is my entry. Fucking send it from here. Okay, and that was the push. Disgusting. Now the question is, where is it going? Well, we know a liquidity edge where it's going already. But the difference is, how much do I actually want to ride this? Okay, so this was obviously news on Sunday. I don't trade market open on a Sunday. I just don't know what the fuck it's doing, and I don't like that. Sellers tried to step in, bearish candle, buyers kicked in. Now, realistically, if I wanted to, I can protect my position under those buyers. Think about it as a barrier. If I know buyers are sitting there, I know that if price tries to drive it back down, these buyers will protect my position, okay? So drop it slightly below that. If it's on a good day, we can see that push, and then we can ride it up. Sellers have stepped in, so what does that mean? I can close my position. Let's try to find another example. Let's go to our 2 minutes. So let's, obviously we want to, I can't even speak, it's 2:48 in the morning, I'm knackered. Our 2 minute New York Open has hit a 96% win rate in the last 3.5 to 4 weeks. And that is basically a opposing candle, 9:30, opposing candle, take the actual liquidity edge area, and there you go, prints, happy days, we know that already. Difference is, what about if we're going into 9:38? Okay, what about if we're at that 9:28? So we already know that London is swept. Okay, this was the sweep, buyers tried to push in. This is why location is important. Okay, this in a range doesn't mean shit to me. I also know I'm in a range because we've got liquidity edge areas printed on a heat map basis. It's a magnet. Okay, so right now it's equally spaced out. We're smack bang in the middle. Right. So now that was the first move. Here was the second move. We're still in a range. If I wanted to be aggressive, I could take a sell here, wait for this candle to close. We would have taken a few points, a few ticks even, 3-4 points, and then try to ride that out and now say, okay, so buy, and then see what happens going into market. Bit of a gamble, okay? This was the push. This was our 2 minutes. Bullish absorption located in a selling area. Bullish absorption in a selling location, I'm not getting involved. And this is why. Really clean example. This is why location is so important, okay? Now we've got bull step in. Now, if you were trading live, you would have seen this live if your confirmation only bars were switched off, okay? So you would have seen this starting to print. You could have started riding it. This is on a 2 minute. On a 1 minute, what did it look like? This is what it looked like on a 1 minute. Sellers started trying to step in. The candle closed bullish, and we closed in a bullish location, okay? So all of these sellers stepped in, couldn't actually break that, clear wick down onto the downside. Aggressive push would look something like this. An aggressive entry would look something like this. Buy, sell at our protected area, maybe take our profit where we know the sellers are sitting, okay? As opposed to wanting to take it up here where the true sellers are sitting, the true sellers that created the momentum. Say if I wanted to break it down into 3 contracts and 3 contracts, I can do that. Or if we see a bit of a push, I can move my, oh, well, there we go, TP hit. But I can move my position with it alongside it, okay? I'll find one more example for you guys. Nice example here. I clearly know we're in a bullish trend here, okay? So I can anticipate, if there's a previous high up here, I can maybe anticipate that this will be a drop down. If I wanted to be super aggy, I can take a sell, place my stop loss right at the peak of that absorption, Maybe you would have taken a few points, maybe you wouldn't have. Peak of that absorption. This is the first bearish candle that printed with bearish absorption. But what about if you waited for location? Location kicks in, bears kick in, we can then see where true participation and absorption took place, and that is the push down. Okay? Again, location is very fucking important. Every single time, location is important. This isn't just a, I see a bubble, take a trade. Okay? That is why I'd say is one of the key things. Nice liquidity edge area printed, absorption took place, nice bearish candle, sellers stepped in, took a nice little ride down. Okay? Swept this previous low after some form of consolidation. Nice bullish candle took place. We could have waited. This would have been the break. Sellers clearly aren't in play anymore, and take it down. And this is a nice example of placing your stop loss in protected areas. Okay, so let's say we moved here, and my protected area, as opposed to having it all the way here for 13 points, I can keep it under this little bullish bubble here. Okay, that's pretty much it. I'll probably run a quick speed and change this to 1.3x. If you haven't already got the indicator, click down into the description below. But you're missing out. I'm not saying it to you, but thousands of others are. I'm out.